$1,160 million. That was the total value locked of Sonic not too long ago. Today, it is sitting at barely 100 million. That is a brutal 91% wipeout. If you look at the raw data, this is the biggest DeFi loser right now. The transactions are hitting record lows, and the sentiment is completely in the gutter. But here is the contrarian question nobody is asking. Why is the team opening a massive office in New York and pushing a business-first pivot exactly at these lows? We are sitting at a critical line in the sand, 9 cents. If we lose this level, we enter price discovery to the downside, and it gets ugly. But if this smart wallet upgrade and the new monetization model actually work, this could be the lowest risk, highest reward entry of the entire cycle. Today, I'm going to show you why I'm still holding, despite erasing all my previous profits, and the exact price level that invalidates my entire thesis. Right now, Sonic is trading around 10 cents. If you have been watching the charts, you know it has been painful. We have seen a slow, bleeding grind downwards for months. The market sentiment? It is beyond fearful. It is apathetic. People have stopped caring, and that is usually when the real moves happen. We are looking at a scenario where the price action is seemingly dead, yet the infrastructure development is accelerating. It creates a massive divergence. Most retail investors are chasing the green candles on the high-flying meme coins, ignoring the infrastructure plays that are currently repricing. But why does this specific video matter today? Because we are testing the absolute bottom of the range. We are essentially back at the all-time low support region. This is the moment of truth. We are going to find out if the market believes in the rebrand and the migration, or if this project is destined to fade away. There is no middle ground here anymore. The technicals are screaming that a decision is imminent. But to understand which way it breaks, you have to understand the fundamental shift that just happened behind the scenes. Let's look at the fundamental reality, and I'm not going to sugarcoat it. The on-chain data is concerning. As we saw from the DeFi minimalist reports and token terminal data, active users and revenue have flatlined. Revenue for the last 90 days is only around $147,000. For a Layer 1 blockchain competing with the likes of Solana or Tron, that is incredibly low. It puts Sonic at rank 22 in revenue, with a market share of 0.1%. That is the bearish reality we have to accept. However, this is where the narrative gets interesting. Sonic Labs knows this. They aren't blind to their own data. That is why we're seeing this aggressive pivot reported by Cointelegraph. They are moving away from the speed narrative, because, let's be honest, every chain is fast now, to a survival and business-first strategy. They are implementing something called FeeM, or fee monetization. This is a tiered reward system for builders and fixed rewards for validators. The goal is to create measurable, lasting value rather than just speculative hype. They are trying to turn the chain into a revenue-generating business rather than just a tech demo. On top of that, we have the Pectra update. This is huge for user experience. It introduces smart wallets at the contract level. This means you can now use assets like USDC or USTD to pay for gas. You do not need to hold the native S token just to move funds. It allows for batching actions, approve, swap, and stake, all in one transaction. This lowers the barrier to entry significantly. We also have the Season 2 airdrop claim that just went live. 25% is claimable now, which might create some short-term sell pressure, but 75% is vested as an NFT over 6 months. This vesting schedule is designed to prevent a total dump and force retention. So, you have a collapsing TVL on one side and a complete overhaul of the business model and tech stack on the other. The fundamentals are in a tug of war. But what does the chart say? Because at the end of the day, price pays.
Let's pull up the 3-day chart for SUSD. This is the time frame that cuts out the noise and shows us the true institutional flow. First, look at the trend. It is undeniably bearish. We are trading below the 10 and 21 EMAs. Those represent the immediate short-term momentum. We are also well below the 55 EMA, that purple line, and the 100 EMA, the yellow line.
When price is this far below the major moving averages, it often acts like a stretched rubber band. It eventually has to snap back to the mean, or the moving averages have to come down to meet price. We are currently respecting a harsh descending trendline that anchors all the way back from the high of 90 cents in February of 2025. You can see the rejections clearly: May, August, September, and October. Every time we touch that orange dotted line, sellers stepped in. Until we break that diagonal resistance, the trend remains down. However, look at the support. We are sitting in my load zone, which is between 9 cents and 12 cents. This green box represents the last line of defense. It is the bounce area from the absolute lows. Now, let's look at the indicators. The Heikin-Ashi RSI at the bottom is flashing oversold. I have drawn a small orange dotted trend line on the RSI itself. If we get a breakout on the momentum indicator before we get a breakout on price, that is a leading signal of strength. It suggests the selling pressure is exhausting. Also, look at the volume profile on the left. The point of control, the price level with the most traded volume, is sitting way up at 30 cents. That is a massive gap. In technical analysis, the point of control often acts like a magnet. If we can reclaim the lower levels, price will want to travel back to where the volume is. Here is my personal strategy, and I want to be transparent with you. I have been dollar cost averaging into this since the 30-cent area. It has been tough. I have essentially erased all my profits from the Phantom epoch before the migration to Sonic. But Sonic represents only 1% of my total portfolio. I'm heavy in Bitcoin, Ethereum, and cash. This is one of my asymmetric bets. I'm continuing to accumulate here in this 9 to 12 cent zone. But I have a hard stop. My invalidation level is 7 cents. That is the red dashed line on the chart. If we get a weekly candle close below 7 cents, this setup is invalid. It would mean the support has failed, and I'll not catch a falling knife. I would cut the position for the short-term trade. For targets, if we hold this level, I'm looking at a tiered exit strategy. My first major resistance is 17 cents. That aligns with the descending trend line. If we flip that, the next levels are 28 cents and 40 cents, which align with the Fibonacci retracement levels of 236 and 382. From there, the higher targets are 60 cents, 90 cents, and finally $1.40 at the 1618 extension. Navigating these DeFi markets requires precise portfolio management and understanding where to allocate your capital for the best yield while you wait for price to recover. If you want to see exactly how I structure my farming strategies and which platforms I trust to generate passive income during these drawdowns, I have compiled my entire system in my DeFi guide. It is available in the pinned comment for $4.99. It walks you through everything step by step. Back to the chart, notice the volume shelving. We are building a base here. The volume is thinning out on the sell side. We just need that one spark, that one candle to close above the 10 EMA to shift the momentum. So, what is the game plan moving forward? It is a game of probabilities. The business-first pivot and the US expansion are the fundamental drivers that could justify a reversal. The technicals show us we are at the lowest possible support. The risk-to-reward ratio here is incredibly skewed. If you enter at 10 cents with a stop at 7 cents, you are risking roughly 30% downside. But the upside to the first major target of 40 cents is a 300% move. To the all-time highs? That is a 900% move. However, you must be disciplined. If the market dumps and we lose 7 cents, you have to be willing to walk away or simply hold for a multi-year cycle if you are a true believer. Do not leverage trade this level. This is for spot accumulation only. The volatility here can liquidate you in seconds.
To wrap this up, Sonic is currently the most hated trade in DeFi. The TVL has collapsed and the users have left. But that is exactly why I'm paying attention. The team is not dead. They are aggressively pivoting to a new economic model with fee monetization and better user experience. I'm betting on the reversal from this 9-cent region. I'm betting that the technology and the treasury depth will outlast the current apathy. But I'm also protecting my downside with a strict invalidation level. Let the chart guide you, not your emotions. If we lose support, we adapt. If we hold, we ride. If you found value in this breakdown, make sure to smash that like button and subscribe with the bell on. I post these updates daily to keep you ahead of the herd. Also, join my free Telegram group for faster updates throughout the day. The link is in the pinned comment. I recently covered another infrastructure play that is showing similar patterns.
Check out that video on the screen right now if you want to find more setups like this one. Thanks for watching, never financial advice, and I'll catch you soon in the next one.